and welcome to today's webinar. This webinar today is special because it's being presented by both STEM Lyceums and the Teacher Enrichment Program of the Center for Excellence in Education. My name is Shannon Tyler, and I am the Teacher Enrichment Program Manager, and I am joined today by Rebecca Carter, the STEM Lyceums Program Manager, and we will be hosting today's webinar titled Math Meets Money, Preparing Students for the World of Finance. We are very excited to host our speaker for today's webinar, Dr. John Miller, and we can't wait to hear his talk. So without further ado, let's get started. To begin, I'm going to share some brief background information on our organization. The Center for Excellence in Education was founded in 1983 by Joanne DeGennaro and Admiral Rickover, father of the nuclear navy, and civilian uses of nuclear power. Its mission is to nurture high school and university scholars to careers of excellence and leadership in STEM. We have cost-free programs for teachers and students, including the Research Science Institute, or RSI, USA Bio-Olympiad, USABO, the Teacher Enrichment Program, and STEM Lyceums. I'm going to talk a little bit more about these programs on the next slides. First, we have the Research Science Institute, or RSI, which is a highly competitive 6-week summer science and engineering program open to rising high school seniors, with juniors being eligible to apply. RSI is the first cost-free summer science and engineering program that combines on-campus coursework in scientific theory with off-campus work in science and technology research. Next, we have the USA Bio-Olympiad, or USABO, which is the premier biology competition for high school students in the United States. It provides the motivation, curricular resources, and skills training to take them beyond their classroom experience to the level of international competitiveness. A fun fact about the USABO is since CEE began administering the USABO in 2003, every member of the USA Bio-Olympiad team has medaled at the International Biology Olympiad. Next, we have the two programs that are hosting this webinar today. The Teacher Enrichment Program, or TEP, provides opportunities for middle and high school teachers to connect with leading experts from industry and academia, explore cutting-edge research and development, and make meaningful professional links with direct benefits for you and your students. Next, we have STEM Lyceums, which is the newest initiative here at CEE, and it is a virtual club for high school students to meet once a month to learn about STEM career pathways from leading field experts. Industry professionals share cutting-edge research and offer unique learning experiences like scholarships and internship opportunities for high achievers. To learn more about our programs and opportunities, please visit our website at www.cee.org. Before I introduce our speaker, I would like to encourage you to take notes while you listen and to ask questions. Please submit your questions through the Q&A function or in the chat, and they will be addressed by our speaker at the end of the presentation. Also, the recording of today's webinar will be emailed to all registrants, so you can come back to it and watch it at your leisure. Now, I am very happy to introduce today's speaker, Dr. John Miller. Dr. John Miller is a senior lecturer in the Department of Applied Mathematics and Statistics at Johns Hopkins University. He holds a BSc in Electrical Engineering from Princeton University, earned in 1992, and a PhD in Mathematics from Rutgers University, completed in 2015. Prior to his academic appointment at Johns Hopkins, Dr. Miller spent over 15 years in the financial industry, where he held high-level roles at Credit Suisse in cities including Tokyo, Hong Kong, New York, and London. His positions included statistical arbitrage trader, managing director of equity derivatives trading, and the global chief risk officer for the equities division. Dr. Miller attended CEE's Research Science Institute in 1987. At Johns Hopkins, Dr. Miller brings this wealth of real-world experience into the classroom, teaching graduate-level courses in quantitative equity trading and exotic equity derivatives. His academic and professional work sits at the intersection of quantitative finance and computational number theory, with a strong focus on bridging theory and application. His teaching emphasizes practical problem solving using advanced mathematical models, and his courses are especially popular among students preparing for careers in quantitative finance. Thank you to Dr. Miller for joining us today. We welcome you, and we really look forward to hearing your presentation.
Yeah, thank you very much. I have some slides, which I'll try to follow, but I may go off on a tangent. So let me first say a little bit about my journey, how I ended up where I am now. In high school, math was far and away my favorite subject, but somehow I was convinced not to major in math in college, that I majored in electrical engineering. Probably someone told me that was more practical. It turned out it wasn't practical at all for me. I looked around for a job as an engineer and I couldn't find one. And just as a spur of the moment thing, I interviewed at one Wall Street firm that came to campus back when firms come to campus. Now everything's by video, but and they offered me a job in their IT department as a programmer. And I joined them, and they transferred me to Tokyo, Japan, where eventually I moved over to become a stock trader and trading stock options. And I was at this firm for 15 years, and I left in 2007, shortly before the financial crisis. And uh, and then I went to pursue a PhD in math. I was about 40 years old when that happened. So if anyone wants to know about what it's like to try to get a PhD when you're 40, you can feel free to ask me. Um, and after that, I joined Johns Hopkins, where I'm a lecturer, and I teach our undergraduates and our graduate students about the financial markets and how to apply mathematics to them. And also, I do a lot of counseling and mentoring for students who are interested in the financial industry and looking for jobs there and want to know what kind of jobs to look at, what kind of firms, what kind of preparation they should get. And so the chart I'm showing you here is kind of I made up a little a map of the financial industry to try to guide students in the sort of different kind of jobs there are. And we're not going to go through every circle, but um, I mean, broadly speaking, there's what we call the buy side. So asset managers and hedge funds who are investing clients' money to try to get re investment returns for their clients. And that what we call the sell side, investment banks, commercial banks who are essentially selling financial products. And there's overlap between all of these things. For example, investment banks often have asset management arms. And in the lower left-hand corner, we have a little complex of service providers. So there are the firms who they're not investing money or trading money or doing transactions, but what they are doing is providing data or providing analytics or other services to investment firms and banks. And the kind of jobs available at all these different firms, they vary quite widely. So, so why would someone want to work in financial services? Like, why should a student decide whether they're interested in this or not? So, first of all, they should have an interest in economics or finance or markets. It should be interesting them. They don't have to be knowledgeable about it per se. They're just students. They don't need to know everything, but they should at least should be interesting to them. For people who go into it who are really not interested in it, they tend to burn out quickly. But if you have a genuine interest in finance, then you can be successful. Uh, the industry is global in scope. I worked in a number of cities around the world, and when I worked in Hong Kong, there were people from Canada, India, Turkey, Switzerland, Spain, and so on, who all worked in the same office. So it really is a global industry, and you have the chance to interact, to travel all over the world and interact with people from all different cultures and different parts of the world and different backgrounds as well, academically and otherwise. Uh, in finance, we can apply if you have quantitative skills or programming skills or interpersonal skills, there's many different ways you can apply them. Of course, we can imagine, in quantitative finance, we need math skills and computer skills. But the finance industry is much broader than that. We're looking for people who have strong ability to communicate, who can work well on teams, especially who can sell. At the end of the day, the financial industry is an industry, it's a business, and they're trying to sell things. They're trying to sell products, they're trying to sell services. So we're always looking for people who can interact well with others. Another thing to keep in mind about careers in finance is they're very specialized. And when I was doing what I was doing, maybe I was probably the only person at my firm that did precisely what I did. And maybe there is a corresponding person at another firm. So maybe there is 10 people in the world who did what I did. And that's what the financial industry looks like, is a lot of very specialized areas, and it takes you years to sort of build up the experience in that particular area and to really add value. So the benefit of that is because it's very specialized, you can make a very good income, but without being particularly talented. It's definitely the case that all kinds of people can be successful in finance. It's not like it's different from, say, you want to be a doctor, right? You want to be a doctor, you need to go to medical school. That's hard to get into. I can't guarantee any particular student that they can become a doctor. But I can almost guarantee anyone, if they want to go into the financial industry, they're going to be able to find a place and they're going to be able to be successful. They just need to work hard, need to enjoy what they're doing and work hard at it. Another thing is a lot of students think that they have to major in economics or business to go into finance. It's not true. Financial firms, they're very agnostic about the kind of students they're looking for in terms of their majors. They're looking for skills. They're looking for interpersonal skills. They're looking for coding skills. They're looking for data skills. They don't care if you've majored in art history or quantum mechanics. They're quite happy to hire you with whatever major if you're satisfying their particular needs. So really any major is okay. So what is finance exactly? So maybe I should back up a little bit. So finance, the way I think of finance is essentially the problem of finance is to either you're receiving cash flows over time or paying them or somehow exchanging cash flows through time. Maybe we invest some money today, receive returns in the future, or maybe we need some money today, maybe we need to borrow money, maybe a student loan, borrow money for a house, and we have to pay that back over time. So finance is a problem of sort of looking at and kind of analyzing those flows through time. And what I want to do today is to talk about some just very basic concepts, but still big concepts in finance and the kind of math at the high school level, math at the college level that we can apply to them. And then I want to wrap up at the end and talk about what's the advice we should give students and how maybe we can prepare them. First, big concept is cost versus benefit. So this is something that we learn about when we're very young, right? You get an allowance, you get your $5 a week or whatever it is, and you have to decide how to use the money that you have. Do you want to buy that piece of candy or not? Do you want to buy a toy? Are you going to save it for the next week, right? Or maybe, right, as an adult, do you want to buy a car? Should it be an old car or a new car? Do you want to buy a house or do we want to rent? We have to make choices. And when we're making those choices, maybe they're binary choices, yes or no, right? Do I want to buy a house or not? Or maybe we have multiple choices, or maybe a range of choices. Maybe we're constructing a portfolio. The important thing is to make sure that we've accounted for all of our costs and all the benefits. And sometimes we don't know precisely what the costs and benefits are. So we do our best to make estimates. So the math of this isn't hard. It's really just arithmetic. We're adding things up and just trying to make sure we capture as much as possible. Although for some more complicated problems like portfolio construction, right, we have so many choices that we need to compare that maybe we use calculus or linear algebra, what we call optimization, to try to find like what's the optimal amount of what we want to buy of each thing. But I want to just do a simple example, something that I would go over with my kids. And that's whether we want to buy a new car, an old car, or a new car. So you can imagine, right? You have $40,000 saved up. And you're trying to decide whether to buy a new car, costs about $40,000 these days, or maybe a 15-year-old car, which will cost you about $10,000. So, so when you're thinking about this problem, we want to think about how much does it cost for us to drive this car for 1 year, right? I want to put a timeline on it so that way I can get more specific about how much everything costs. And the first thing to think about is if I buy a car today, it's going to be worth less a year from now. Uh, or if I want to buy a new car, if I want to buy a car, but I delay my purchase for 1 year, right? A 2025 car, I can buy 10% cheaper 1 year from now. So I need to factor in the depreciation. So an old car, maybe that depreciates $1,000 a year, but a new car going to depreciate $4,000 a year. Also, if I buy the old car, I'm going to have money left over, right? So I can put that in the bank. Maybe I make 5% interest. So I can make $1,500 for this. An old car is worth less. The insurance is going to be less. But it'll cost more to maintain, right? Maybe it breaks down more, it needs more repairs, and so on. We add all these up, right? And I find that an old car is going to cost me about $6,000 a year, but a new one's going to cost me about $9,000. So this is just a good example for students of, right, when they're thinking about these choices, it helps to kind of quantify all the different things and make estimates for everything. And then they can decide, right, do I want to pay an extra $3,000 for a new car over the next year, right? Are they going to get $3,000 of benefit of having something more reliable or something safer? Anyway, the math here isn't hard. It's just arithmetic. But there is something subtle here, right? We're thinking about what's the price of a car today and what would be the price of that same car 1 year from now. And this gets into the issue of how do things evolve over time. So, right, if finance is all about how do we exchange cash flows through time, um, like one basic idea is, right, what if we invest money today? How much are we going to get in the future? Right? What's the future value of our investments? And the flip side of that is if we know we need a certain amount of money in the future, maybe we need to, right? Maybe we need $250,000 to pay for 4 years of college, or maybe need money every year for 30 years to pay for our retirement, whatever it is, right? Then we want to ask, like, how much money do we need today to pay off those obligations in the future? And how much we need today, we call that present value. And these are kind of the really two big fundamental concepts in finance. And from a mathematical point of view, they're pretty easy to deal with, right? If we're investing money in the bank and we get a constant rate of interest, right, that's going to compound over time. We're going to see some kind of exponential growth. On the other hand, if we have a stream of cash flows in the future a stream of obligations in the future, we're trying to find out how much money we need today to invest to meet those obligations. Then we see things like series, finite series, infinite series, often geometric series. These are all great things for students to play around with. So to make this concrete, I'm just going to give a very basic example. I know everybody's already probably seen all this before, but so for example, if you have $10,000 today and you want to invest at a 5% interest rate, and you know you're going to get 5%, and you invest over 20 years, right? Compounded, how much will you have at the end of 20 years? And you have about $26,000, right? That it's growing exponentially through time. To turn around backwards, suppose that you want to generate $50,000 a year every year for the next 20 years. Maybe you have a lump sum and you're looking to buy an annuity or you need to fund your retirement. So we work backwards, right? To get a payout of $50,000, then we work backwards to find out how much do we need today. So we divide by 1 plus 5%, and we raise it to the kth power, the number of years, right? And that's how much we need to make that particular payment. And then we sum up over all 20 payments. So what we have is just a finite geometric series. And it turns out we need about $600,000, right, to pay off these obligations. So bankers, people in finance all the time, they're always doing these present value calculations. They're estimating future cash flows. They're applying interest rate to discount it and figuring out how much are those cash flows worth today. However, when in those examples I was discussing, we knew for sure what our cash flows were going to be, and we know what interest rate we're going to get. But in practice, right, there's a lot of uncertainty about future cash flows. There's a lot of uncertainty about future interest rates. We don't know what investment returns are necessarily going to be because the future is uncertain, right? We have the economy can change, right? Government policies can change, geopolitics, weather, right? Financial conditions, technology. So the future is really inherently uncertain, and we want to be able to think about different possible outcomes. And so what we try to do in finance is to model different outcomes using probability, right? Maybe there's some chance that the economy is going to be good or the economy is going to be bad. Or maybe we model stock price returns. We think it's some kind of bell curve or normal distribution and so on. So we treat things as random variables, and we can ask questions about what is the mean of this random variable? What is its standard deviation? What is its variance? How are things correlated with each other? And once we have a probabilistic model, often we want to estimate the parameters that go into it. Like, where should the center of our distribution be, right? How wide, if it's a bell curve, how wide should the curve be? And, we can guess at it, or we can look at historical data and to try to estimate it. And then that gets in the problem of statistics. So just to give some really a basic example to start with, right? Imagine that we're trying to model the returns of stocks, right? So they're roughly, right, the return of a stock, say over the next year, maybe it can go up 20% or down 10%, whatever. It's going to have some kind of distribution. It'll look something like a bell curve, right? Approximately normally distributed. Maybe the tails are a little bit fatter than that, but it'll look something like that. And so now imagine then I have a stock like that, and I'm going to model its annual return as a random variable. I'm going to call it R1. And I assume that the mean, the average return is going to be 10% per year. But I don't know that for sure. There's going to be risk involved in it. And so I can calculate the standard deviation, I can estimate the standard deviation of these returns. Let's suppose we assume it's going to be 30%. That's what we call the stock's volatility. And let's suppose I have a second stock, and that's similar to the first stock. It's got 10% mean returns, but over time, but the standard deviation is 30%. And importantly, I want to assume these two stock returns are independent of each other, that one stock does not influence the other stock's return, that they're uncorrelated with each other. It's a little bit unrealistic assumption, but let's assume that. So now let's suppose that I want to invest half of my money in the first stock and half in the second stock, right? Well, what's my expected return going to be? Where's that center of that distribution? It's still going to be 10%. Half of 10 plus half of 10 is still 10. But the standard deviation, the variance of this and the standard deviation of it's going to change, right? Because there's the possibility that if these stocks are independent of each other, one might go up and one might go down. So sometimes the risk of these stocks may somewhat cancel each other. And so we can work out that the variance of, since the variance of a sum of two random variables, if they're independent of each other, is the sum of the variances, and we take the square root, it turns out that the standard deviation of returns, the volatility of returns of this portfolio of two stocks is only 21%. So we've kept the same return, but we've reduced our risk. And so this is really a fundamental concept in finance, is we want to be able to preserve the returns that we're targeting, but with as little risk as possible. And to get there, we want to diversify over as wide a range of assets as possible. Different stocks, stocks and bonds, US stocks, international stocks, and so on. So, and this is just a basic example of that. Let me do another example of uncertainty. It's a little more subtle, um, and that's estimating the mean of returns. So actually, let's back up a second. So I gave you this bell curve, right? And we have the dotted line. That's the center of the distribution. That's the mean or the expectation of the distribution. Now, if I say, oh, the expected value of a stock's return is 10%, the mean return is 10%, right? Well, how do I know it's 10%? I can assume it's 10%, but how would I know that it is, right? Well, we can look at historical data over time to try to estimate it. So this dotted line, right? I don't know where it is, but I'm trying to estimate it. So there's uncertainty involved in where this dotted line is. So let me give you an example, and it's probably the most important example for all of us, and that's the US stock market. Um, so in the 95 years that the S&P 500 has been around, up to 2023, uh, the stock market returned about 6.5% above the rate of return of short-term interest rates. So we think about, right, when I think about short-term interest rates, usually maybe we think about treasury bills. These are like 1 month or 3 month short-term short-term bonds the government issues, essentially risk-free rate of interest. And I want to know, right, how much extra return I get for investing in stocks. What's what we call the excess return or the equity risk premium. And if we look back historically, we get on average about 6.5% extra per year. And that's been right compounded over, the last 95 years. 6.5% is a lot, is substantial. And it's a little bit of a puzzle, why that's so high, has been so high. That said, the US has been exceptional. If you look at other markets, Japan, Europe, China, their stock markets have not returned as much over time. So maybe we've just gotten lucky. I don't know. And so to put these returns in perspective, if you took $100 and you invested in 3 month treasury bills in 1928, right, you'd have $2,000 at the end of 2023, right? You barely kept up with inflation. But if you put it in the S&P 500, you'd have about $800,000, right? So a big difference. Now, that has risk associated with it. And if you look at the standard deviation of these excess returns, the volatility of these extra returns, right, is about 20% a year. So, okay, we've observed that we're getting an extra 6.5% return over the last 95 years. But how do we know, to go back to this picture, we don't know that 6.5% is right where that dotted line is, right? There's some statistical error associated with it. In fact, the way we want to think about it is every year I observe a return, right? I'm picking one return out of that distribution. It could be on the right side, it could be in the left, it could be in the middle. And I do that 95 times. Suppose I draw 95 different samples from that distribution, and I take the average of them, what we call the sample mean, right? There's no guarantee that sample mean is going to be, it might be close to this dotted line, but not going to be quite on it, right? It could be a little bit to the right, it could be a little bit to the left. And what we can do is we can estimate how close we expect that sample mean to be to the true mean. And so we would take sort of the standard deviation, we divide it by the square root of the number of observations, right? And we get that the standard deviation of our sample mean, what we call the standard error, is going to be about 2.1%. And what that means is that given a true mean, which we don't know what the true mean is, we don't really know what stocks are going to return over time. But what we do know is that there's about a 90% probability that our particular observation of the sample mean that we just observed over the last 95 years is within 1.6 standard errors of the true mean. In other words, a 90% confidence interval of 3% to 10%. What this means is, yes, we've observed that we get an extra 6.5% return a year from stocks, but we're not guaranteed 6.5% going forward. Aside from the inherent risk, we know like year after year, there's there's volatility in the bell curve. There is a random distribution, but there's even uncertainty where the center of the distribution is, right? It could be 3%, it could be 10%, right? We don't know. And just to give you an idea, um, how big a difference that would make, if we invested $1,000 at and got for 50 years, we invested $1,000 and got a 3% return, we'd end up with $4,400 at the end of 50 years. But if you had 10% return and you invest $1,000, you'd end up with 117,000, right? So is whether we get three expecting going forward in the future, if we're getting an extra 3% for stocks or an extra 10% makes a big difference. And we don't know. You don't know. I don't know. Nobody knows what that true equity risk premium is, right? And what has it been, right? What is the true equity risk premium, and what will it be going forward? We really just don't know. This is one of the big problems in finance is estimating, right? We can never know exactly what future returns are going to be, but one of the big problems in finance is trying to figure out what this dotted blue line is. We just don't know, right? There's too much statistical noise. So those are some basic ideas using sort of, high school, college math, probability statistics. But there have been a lot of advances over the last 20 years, 20, 30 years. And in the 1980s, in the 1980s, investment banks and hedge funds began to collect and analyze large volumes of data. Maybe they look at thousands of stocks and recorded their prices, every second or every microsecond. And they would try to analyze these patterns in order, right, to find ways to make a little bit of extra money, right? These stocks, they move around randomly, but it's not quite random, right? Maybe there's little inefficiencies, little patterns people can find to make a little bit extra. Also, right, beyond just for trading stocks or other trading other assets, there are other applications to big data. For example, if you're a credit card firm and you're looking to avoid credit card fraud, and there's these big databases of credit card purchasing behavior, right? How do we go in and how do we find which transactions and flag them as potentially fraudulent? So for this, this is where has been the advent of machine learning. So all machine learning, when people say machine learning, what is machine learning? So imagine, well, actually, let me draw a picture here. So just switch my screen for a second. All right. So imagine that, right, we observe some X variable and some outcome Y, and we have some data points, right? And I guess we all are familiar with like linear regression, least squares, where we try to fit a line of this data pretty well. Now you can imagine then that instead of this, we might have, right, something more complicated, right? Maybe, right, there's some pattern to this that's not linear. And maybe it's not only is it a function of one variable, but it's a function of many different variables, right? So we have, maybe it could be even 100 different variables and there's these complicated patterns, right? It's hard then for just normal linear regression to kind of figure out how to draw some kind of curve through there. But these machine learning techniques, right, things that come up like random forests and neural networks, essentially what they are is they're interpolation machines where they can interpolate very complicated, you can give it a bunch of complicated data and it can interpolate for you, right, in between the data points that it got, even over very complicated patterns with many different inputs, very high dimensions. And it's important that we say interpolation, they're not good at extrapolating. So if you take them outside of the range of data that they've seen before, right, they're not going to know what to do. So you, for example, training, a self-driving car, right? If it's in situations that it's seen before and it knows how to react, then it's going to do okay. But if you throw out something that it's never seen before and it's trying to extrapolate from the data it has, right? We're not going to, it's not good at extrapolating. It doesn't know what to do out on these edges. Anyway, machine learning, we use it a lot in finance now, especially for things like credit card fraud detection and other things. But still, for a lot of investing in stocks, stocks don't really look like this, right? Stocks are stocks look more like this, but with more noise involved in it, right? If we have some input and we're trying to predict returns, then there's going to be so much noise involved that these machine learning techniques don't really work. So what we do is we still we still use linear regression, we still use least squares. It's still like the real workhorse technique for trying to fit investment returns to other things. So linear regression, least squares, still very, very important. All the students want to do machine learning, but they need to learn linear regression first. Um, so now this kind of data I talked about is like tables of numbers. But in fact, if you go out into the world and look at data, right, these tables of numbers, what we call structured data, only makes up, let's say, like 20% of the data available to us. Most of the data in the world is unstructured, right? It doesn't fit into nice tables. And a big example of that, especially in finance, is text, right? We get news articles or annual reports that are filed with the SEC or transcripts of earnings calls, right? These are all like text data. And uh, we'd like to be able to analyze this kind of data. Maybe assess, like, is it positive or negative sentiment? Is it, kind of ask questions of that data, of text data in an automated way, keep track of the different topics. And up until about 5 years ago, the techniques available to us were really pretty elementary. For example, you have something we call sentiment analysis. Well, all that is we take a news article and you look at the words, and words that sound good, like beautiful or amazing, we give a positive score. And words that sound bad, like unfortunate or uncertain, we might assign a negative score to it. And then we add up those scores and we get some kind of sentiment score, a positive or negative, right? That's really basic. It's just counting up good and bad words. But about 5 years ago, um, when with the advent of GPT and other large language models, it was really an extraordinary leap in what we were capable of. So now you can take a news article or something and you can, right? And now with large language models, they can understand, they're not just counting words, they can understand what the article says. It can essentially understand meaning. You can use it to ask questions, to summarize it. And not only that, but now we can, right, with ChatGPT, it doesn't just able to understand language, but it can generate its own language, right? It's so-called generative AI. And of course, as everyone knows, it's no secret, right? It's a big trend in all these different industries and in finance included. Um, we're not using generative AI for investing decisions, right? We don't use ChatGPT to tell us what stocks to buy. But um, when our boss asks us to do a project, for example, to take a report and put it on the internet for clients, and we have to make some, HTML code or JavaScript or something, some web app, right? We don't know how to do it because that's not what we know how to do, right? We can get, right, ChatGPT or Claude or whatever to help help us tell us how to do it, right? Right, help us write the code, at least some starter code to get something up and running. So something that would have taken 2 weeks before can now be done in a day. So just the expected turnaround time for, and this is true really in every industry now, the turnaround time is just expected is so much quicker. So now the barrier is not so much technical knowledge, but sort of the creativity to how to decide. We have these powerful tools, but how do we decide what to do with them, right? So anyway, so that's sort of a summary where I think that some basic math ideas and where things are going, the more advanced things that have come along in the last decade or so. Um, but what should we tell students? So first of all, I want to emphasize again, for working in the field of finance, any major is okay. You don't have to major in economics or business. You don't need to, be an expert in finance. A lot of firms will say they want to hire people who are good at math, who are good at coding, who are good with data. They don't want to train them to be a good coder, but they're happy to train them in finance. They have their own, each firm has their own specialized field that they're in and their own finance that they're interested in, and they will train new employees in these areas. So it is not critical that students know finance in order to go into finance. But it's good to take an interest in it, right? So students should, they want to be able to show, first of all, they should know whether they're interested in finance or not before they go into it. So they should read the news. They should read the Wall Street Journal or Financial Times. Follow what's going on in the world and just to understand, have an awareness of what's going on, and especially to also understand the vocabulary, right? It's finance, like any other industry, it's got its own specialized vocabulary. And if you can learn, what's an interest rate or what's a coupon and what's an option, right? What do these things mean? That'll be very helpful. As far as mathematical preparation, right? For anyone going into finance, should know linear algebra. It's probably the most important mathematical subject. Calculus, right? Probability and statistics. You should have some practical knowledge with working with data. Uh, Collecting data and cleaning it is probably 80% of the time you're going to spend working with data is collecting it and cleaning it. And then with the other 20%, exploring that data, analyzing it, testing, hypotheses. So they should have some experience with that. Technology and coding. This is evolving quickly because you should know how to code. Obviously, the ChatGPT and AI tools help a lot with that, but there's sort of like a force multiplier. Um, these tools will make a poor coder a decent coder and make a good coder an amazing coder. So you want to be a good coder and then have these tools make you an amazing coder. Excel still used very widely in finance, so it's good for everyone to learn to work with Excel. Python also. Yeah, AI tools, we want to changing so rapidly, just using them enough to keep up with it. And most importantly, like students need to have interpersonal and communication skills. They need to be able to be willing to get on the phone with someone and talk to them, right? They need to be able to write a coherent email. They need to be able to get up in front of a room and speak to people. These are all things they need to do, whether they're in quantitative finance or some other branch of finance. They need to be able to do these things. And it really is a key skill for students. So anyway, there's a lot more I could say, but I think I've gone on long enough. But I'm happy to take questions.
Thank you, Dr. Miller, for the wonderful presentation. I think you did a great job presenting valuable information that both educators and students can relate to, while also showing the critical role math plays in the real world scenarios. So we will now open the floor up to questions. I haven't seen any come in yet, but to get us started, can you tell us a little bit more about your journey? So, in particular, what was your path from high school to becoming a professor, and were there any key turning points?
So as I mentioned earlier, I'd never planned on going into finance. It was something I kind of wandered into because that's who was hiring back. This was in like early 90s before the first internet bubble. And I don't regret it. It was a lot of fun. I learned a lot of things. I got to travel a lot. But, after 15 years, when I was about 40 years old, I guess, I was ready for to something, a new chapter in my life, to do something different. And so that's why I decided to get a PhD in mathematics, which was probably the best years of my life. I loved doing that. It was so much fun. It was like a second childhood. I was with all these 20-year-olds and I was 40. All I had to do was study math for a couple of years. Getting a job after that was not easy, right? It's always a academic job market. It's a tough market. But I ended up and originally I was trying to get away from finance, but it pulled me back in. And so that's how I ended up at Johns Hopkins with their financial math program. Um, I see a question in the chat about advice I give my younger self. Uh, that's tough. I probably would say to stuck with, maybe I would have said to stick with mathematics and go with my love of mathematics. Don't try to be practical, but just majored in math. It probably would have worked out fine. And, maybe I would have ended up in, I'd have a different path. I don't regret anything I did, um, I don't, I also feel I missed a lot too, right? I didn't go into technology. I, I never worked for big internet company or Silicon Valley. So, we make choices in life and sometimes, or things are chosen for us. But I would say like go with whatever it is you love that don't necessarily try to be practical because the world is changing so quickly. You don't really know what's going to be practical in the future.
Thank you. We got another one in the chat. It says, what can people do if they major in math?
That's a really good question. I mean, aside from, I think I've argued pretty persuasively that you can certainly go in a finance majoring in math. You can work in big tech majoring in math, um, be a data analyst. A lot of people, we find is a lot of people do math as a second major. So I think at Johns Hopkins, applied mathematics is the most popular second major. So often they pair it with something else, whether it's economics or biology. Medical schools often like pre-med students who have a math background. It's a little unusual. Uh, so I've seen history students double major in math. So uh, and that with a lot of companies in the private sector, right? They're looking for people, they're not looking for specific majors, right? They're looking for people who are generally quantitatively literate and can analyze things and then able to communicate those analyses. So uh, certainly a person in mathematics can do all those things. But similarly, someone in physics or engineering could do those as well.
Thank you. We'll jump to the one that came in the Q&A next. It says, how is the financial world changing right now, and what new developments do new students need to consider?
So yeah, I mean, the big change has been AI. That has been that's changing a lot. It's making us, it's I don't think it's affected the demand for people to work in the field. I think we're always going to need, I don't think people are going to be replaced by AI, but we're going to be expected to use AI as a tool and to be able to use it creatively to do things more quickly, to, uh, to respond to requests in a day rather than a week. So that's a big change. So I think students still need to learn uh, coding, and they still need to know how to write. ChatGPT is not replacing the ability to need to communicate. Even if you are going to use ChatGPT to help you write things, you still need to tell it what to do. Um, you need to give it a good prompt. So it has to be writing skills, communication skills, and coding skills. Still very important. Um, yeah, I would say those are the big changes. You should also know that in finance is more than just working at banks, right? A lot of I think of it more broadly. You've got supply chains, you've got different commodities, you've got trade, international trade, all these areas where they're looking for people who are quantitative, who are good at analyzing things. Uh, there is a question. It was the difference between an actuary and a financial analyst. So financial analyst, it's kind of a general term, right? That's someone that works for a finance firm and is analyzing something. So sometimes people use it more specifically for trying to analyze the finances of a company. An actuary, they're working for insurance companies. They're working for insurance companies to uh, assess like expected payouts of insurance contracts and so forth. Looking at things like life expectancy or what are the payouts expected for health insurance or auto insurance. So the skills are very similar. It's you're learning some finance, you're learning some statistics, you're learning some probability, uh, and so there's a lot of overlap between in those areas.
Perfect. We have another one. It says, what level of math should high school students take? Is it better to take calculus in high school or take it at the university where you want to study?
I think that really, I think that really has to depend on the individual student. Um, if the student is well prepared for calculus, if they've been through algebra 2 and geometry and pre-calculus and they're prepared for calculus and they can take it in high school, by all means they should take it in high school. If they take it in high school and feel like they didn't have a solid enough background, they can take it again in college, right? You can take it twice. That's perfectly fine. But if you take it in high school and you've you've gotten a 4 or 5 on the AP exam, or otherwise you feel very well prepared, right? You can go on to linear algebra, multivariable calculus in college, and skip over calculus. It really depends on the individual students. And again, there's no harm in taking something again when you get to college. It's not a race. You want to get through it and have a solid foundation. So for a 10th grader who's very interested in math and taking several math contests and the stock market competition, would you say it'd be worthwhile to consider the math finance field? Yeah, I would say to consider it, but also um, keep your keep your options open. That's one thing we do in learning in finance is to keep options open as long as possible. Uh, right. If a student should explore what they're interested in, um, you know, maybe read a book on the subject, like a popular book to see if it sounds interesting to them. Explore different things. We don't know, right? We don't know where we're going to end up. And there's no special thing the student has to do when they're in 10th grade to go into finance. Um, but it's something that, if they're interested in it, they'll pursue it on their own. I would say that more math, the better, more coding, the better, no matter what field you go into.
We had another one come in earlier. It says, if you would be a high schooler again, what would you do to be good in finance? And I'm going to add a little bit more to that question and ask you if you're aware of any extracurricular activities or competitions that might be beneficial for students like that.
Oh, there are activities. I can't name any off the top of my head, but there are a number of like stock market and trading contests that are sponsored by firms, and they're not. I wouldn't say they're educational so much because so many of these stock market contests is like kind of throwing darts at a dartboard, but it helps get you familiar with the basics of investing, the mechanics of it, It exposes you to these different firms, and often they use it as kind of advertising for their firm in case you're looking for a job later. So there's these stock market contests, and yeah. So as far as contests, that's what I suggest. There's some Thai schools have investment and finance clubs, uh, and uh, and I think though, right, if you the best way to kind of stay on top of this subject is just to read the newspaper every week, right, and keep track of what's going on in the markets and the economy.
Thank you. I think a lot of the students might be interested in those stock market competitions, so that's a good resource. We had
Mhm.
another one that says, does it really matter if someone graduates from Ivy League or non-Ivy League universities in the finance field?
Uh, well, okay. Yes and no. So let me say how it does matter, and let me then tell you how it doesn't. If you're like when you're at a university and you're applying for jobs and you're looking for bulge bracket firms, these top firms, whether it's a Goldman Sachs, JP Morgan, or a Google or OpenAI, right? When they go to search for some jobs, they let everyone apply, and you submit a resume, you take some tests. But some jobs they're more selective about. They have so-called target schools, right, where they say we're going to interview at. We have so many applications, we're going to filter it down by looking at these sort of target schools. You can get around that, by the way, by using networking, using contacts at these firms to get into it, even if you're not at a target school. But that's just in your initial job search. But once you're in the industry, right, once you're working for a financial firm, they don't care what school you went to. They don't care about your educational background. They only care about like how well you're doing at your job then. Like what have you done for me lately? I've been worked with someone I've worked with when I was in finance. Somebody worked for me who had a PhD. Someone worked for me, never even went to college. And they're and he was as successful as anyone else. There, in that sense, it's very egalitarian. Um, once you're in the industry, it's different from academia. Academia, everyone's always paying attention to what school you went to 50 years ago or whatever. They don't do that in finance. They don't care.
Thank you. We have one last one. If the student is interested in math/finance, what type of summer activity/camps would you recommend?
So, well, I know there's lots of math camps, right, that you can look at. Finance, I'm not aware of finance camps specifically. I just off the top of my head, I don't know. Uh, but what I'd suggest is if you can network, if you know people in the financial industry, and you probably know somebody, um, maybe you can do a short internship or a 2 week visit or something like that. There are uh, there's some often there are opportunities, especially at small or medium-sized firms, if you know somebody there, if you have some personal connection. There's a question about preparing for the stock market competition. I don't know. Like I said, these competitions are more, there's a big random element to it. Um, uh, I don't know how to prepare for it. Uh, like it's I guess you could read the news and look at the news a bit, but there's no real way to prepare for a stock market competition.
Perfect. Thank you to Rebecca too for dropping that math camp link in the
Thank
chat.
you.
If anyone's
Mhm.
interested, you can check that out. And I will wrap us up with one last question for our teachers out there, which is, how can educators help students see the relevance of math beyond the classroom?
Was that a question to me?
Yes.
Sorry. Say
Sorry.
again. Sorry. How
Um,
can we?
how can educators help students see the relevance of math beyond the classroom?
Well, I don't, I just feel like math is everywhere everywhere you look, right? We see mathematics. Um, and especially if you dig underneath things a little bit, right? The way that electricity gets delivered to us, right? right? They're constantly balancing the supply, the load of electricity to make it balance, right? Um, that involves a lot of mathematics, right? The way that when we sign on to the internet and we have these digital signatures, right, that use some cryptography, that's all mathematics. Almost everything behind it has got some kind of little bit of a mathematical background to it. The way cell phones communicate with each other, right? All of these things have mathematics to it, and it's just take a little bit of work to kind of dig into the technology a little bit and find that mathematics. And that's going to be there with almost anything we come in contact with.
Thank you so much. With that, I think we'll go ahead and close our Q&A. If you have any additional questions, I did see a few more come into the chat. I will go ahead and email them to our speaker and he can get back to us. And if you do have any additional ones that you haven't put in there, feel free to email Rebecca or myself and we will get you guys answers to those. To wrap up, I would like to give a special thank you to our sponsors for supporting us and making these cost-free webinars possible for you all. Lastly, I would
Okay.
like to thank you all in attendance today for attending the webinar. We really hope you enjoyed it. I kindly ask that you take a minute to fill out our post-webinar survey. Your feedback makes it possible for us to serve your needs. The links to these surveys will also be emailed to you. So you can complete it at your leisure. A poll should have also popped up. If you can just take a few seconds to answer those quick questions, that would really be great. And then lastly, thank you again to our speaker, Dr. Miller, and to all of you again. We really appreciate your time, Dr. Miller, and taking the time to being with us today.
Thank you so much. It was a
Thank you.
pleasure.